Pay close attention. What you're about to hear is not a theory, it's not leaked information, and it is absolutely no longer just a debate. This is now verified policy in motion. A presidential directive has just shifted the discussion about recurring financial support from pure speculation into the realm of active operational government policy. And there's a critical element almost everyone is overlooking. The pool of people who might qualify has just been opened up, quietly and with deliberate speed. Before your mind races ahead, pause. The details I'm going to share will challenge what you thought you knew. For a long time now, there's been background noise about structured government payments. Online forums buzzed with arguments. Experts contradicted each other. Many claimed it couldn't be done without a full act of Congress. Others dismissed it as mere political speech. But the reality is this: an executive action doesn't require a lengthy congressional process. It doesn't need endless committee hearings. And once it's enacted, federal machinery starts turning, often before the public is even aware a change has occurred. That is precisely the situation we're in right now. This order establishes a mechanism for targeted federal distributions designed to plug directly into government architectures that are already running. To put it simply, they didn't invent a new wheel. They found a key for a door that was already locked, and that's the reason things are progressing so rapidly. The delivery network was pre-built. The payment routes were already charted. The databases determining eligibility were live. All that was needed was the directive to wire them together in a novel way. Let me state something unequivocally from the start. This does not equate to every American finding $2,000 deposited by morning. Anyone promising you that is not telling the truth. However, it signifies something major. The scope of potential eligibility has been dramatically broadened. And most of the people newly brought into consideration have no idea yet, because they're listening for the wrong kind of announcement, the loud, public kind. This is operating on a different frequency. So why does this specific directive carry such weight? Unlike past economic impact payments, these are being categorized internally as dividends, not as crisis relief. That language is deliberate. Dividends are linked to being part of a system, not to an emergency or a disaster. That single shift alters the entire game because, when framed this way, these payments can be routed through long-standing benefit frameworks, tax codes, and established federal account links. This is how the order sidesteps the typical obstacles that have halted comparable ideas before. Why launch this now? The timing is more significant than most people grasp. We are in a crucial transitional period between fiscal years. Budgets refresh, agencies shift allocations, payment platforms update. This is when eligibility rosters get revised, when year-end adjustments create openings, and when operational changes can be executed with minimal friction. Federal systems are most adaptable during this window. The arrival of this order right in the middle of that period is not coincidence. It's tactical. Even more critical is what the document does not proclaim publicly. It avoids naming specific groups. It doesn't use flashy terminology meant for news banners. Instead, it empowers agencies to recognize, broaden, and modify qualifying groups using income indicators, benefit history, and system participation markers already recorded. This is why the public hasn't fully pieced it together. They're waiting for a siren when only a signal has been sent, and a precise signal is easy to miss if you aren't tuned to the right channel. While social media fights about whether any of this is real, the backend mechanisms are already activating. Internal markers are being updated. Accounts are undergoing review. Payment corridors are being established. Eligibility parameters are being fine-tuned. Here's what should really capture your focus. The original categories everyone fixated on are no longer the complete story. New groups have been silently added to the equation. Individuals who were previously informed they didn't qualify might now fit a revised designation. But you won't discover that unless you grasp the mechanics. This framework does not demand you submit an application immediately. It doesn't instruct you to register on a new website, and it won't send push notifications to your phone. It functions through pre-existing systems that assess eligibility in the background, which means for many their standing could be decided before they even hear an official word. This is where misconceptions take root. People assume that if no action is required from them, there is no opportunity. That is incorrect. Sometimes no action means you're already in the evaluation queue without your knowledge. Let's tackle a vital question. Why the quiet approach from officials? Because directives of this nature are crafted to minimize political static during the initial rollout phase. Agencies require alignment time. The Treasury needs to finalize transfer protocols. Federal datasets must sync. If public promises were made before that groundwork was solid, mass confusion and unmanageable expectations would erupt. So they let the operational process lead, and the public communication will follow. That is the exact sequence unfolding as we speak. Now temper that anticipation with this reality. Not every qualified person will see an identical amount. Not everyone is in the initial distribution group, and not every payment will be a neat, round number deposit. However, the $2,000 figure is a genuine top-tier benchmark, not an internet fabrication. Who approaches that ceiling depends on classification, income indicators, and benefit interplay. And let's be clear, this is not a substitute for Social Security. It isn't cutting SSI or reducing SSDI. For numerous recipients, those very programs are the reason they're now on the radar. But I'm getting ahead of myself, because the most common error people make with news like this is presuming they know who's included before seeing the full, expanded picture. And that's exactly what we need to explore next. In just a moment, I'll break down who is now in the mix, the logic behind these groups, and why so many are still blind to their own potential eligibility. And when I reveal which category caused the biggest ripple within the system itself, you'll see exactly why there hasn't been a loud public campaign. Don't go anywhere. What comes next is crucial. Let's slow down and get specific, because this is where misinterpretations run wild. When the concept of structured payments first surfaced, the assumption was binary. You either fit a clear, narrow category, or you were out. That is not how this executive framework functions. It didn't create one new beneficiary box. It redesigned how qualifying individuals are identified. That's the pivotal change. Instead of asking, are you in this single category? The system now evaluates, how many data points across multiple programs do you match? That one adjustment has extended eligibility far beyond initial projections. Here's the old model. Early talk centered on limited groups, recipients of specific federal aids, certain strict income brackets, small pilot populations. If you fell outside those strict lines, you were told the matter didn't concern you. The window was shut. The new model doesn't look at one box. It examines layers, income trends, benefit overlaps, household composition, and participation flags already present in federal files. It's a multi-factor review, not a single yes/no question. Listen closely now. One of the first groups receiving expanded attention is seniors on fixed incomes, particularly those whose benefits haven't kept meaningful pace with rising costs. This doesn't blanket cover all Social Security recipients. It focuses on seniors whose income data shows a squeeze, expenses climbing without corresponding income growth. That pattern creates a data signature the new framework is built to notice. Another group entering the expanded pool includes individuals linked to disability, not just those on SSDI or SSI, but people whose records reflect long-term disability status combined with work limits, partial earnings, or benefit reductions. Most never check for this category themselves because it isn't always printed on a benefit statement. It's embedded in case files the system maintains internally. Then there's a group nobody was discussing. Low to moderate income working households with unsteady, seasonal, or interrupted earnings who interact with federal systems via taxes, healthcare subsidies, or benefit adjustments. These people were previously bypassed because they didn't resemble conventional aid recipients. They weren't on traditional assistance, they were employed. But their income instability creates a vulnerability the new model acknowledges. Now they're being assessed through a different lens. Here's a pivotal point that changes everything. This expansion isn't instantaneous. Agencies were guided to prioritize pre-existing data over new applications. Why? Speed and efficiency. If the system already knows your identity, earnings, and program interactions, It can evaluate eligibility silently, avoiding paperwork logjams. This means some will be included without ever knowing they were under review. Their status will be determined in the background. Let me clear up a major falsehood spreading online. This is not a universal handout. It is not free money for all. And it does not mean an open enrollment period where anyone can sign up. This is a targeted, data-informed expansion. And that's precisely why so many are missing it. They're searching for the wrong clues. Another group gaining attention: households affected by benefit overlap penalties. These are people whose cumulative support seems substantial on paper, but in reality is split across several programs, often leaving them with unreliable monthly stability. For years, these families fell into cracks. They earned too much for full assistance, but too little to be secure. Now, those cracks are being treated as signals for inclusion, not exclusion. The system is starting to recognize that complicated circumstances don't equal financial safety. This is where income limits become fluid. There's no one magic number where you automatically qualify. Instead, agencies are analyzing ranges and combinations. One income level with no dependents might not trigger eligibility. The same income with caregiver duties or medical costs might. That's why oversimplified charts found online are deceptive. They are too one-dimensional for a system evaluating numerous factors at once. And yes, location plays a role. Areas with demonstrably higher living costs are weighted differently. This isn't about red or blue states. It's about regions where federal data reveals economic pressure, cost of living gaps, and financial strain. Again, these are quiet calibrations, not press releases. The system accommodates local economic realities without fanfare. Now, here's something that shocks most people. Many assume that if you're already on federal benefits, you're automatically maxed out or ineligible. That is frequently false. In many instances, your existing benefit history is the very reason you're flagged for consideration, not against it. The system sees confirmed participation, a verified identity, and accurate financial data. That makes assessing eligibility simpler and faster. You're already a known entity in the database, which accelerates processing. This is also why scammers are already circling. You do not need to call anyone. You do not need to click a link. You do not need to claim this immediately. Anyone pushing for urgent online action is seeking to steal your data or funds. The authentic process doesn't operate that way. It works in the background through official established channels that don't demand your instant involvement. Which leads us to the burning question: if someone qualifies, how does the money actually arrive? Because knowing the delivery process is what separates calm understanding from needless panic. I'm going to outline when payments could realistically begin, how they'll likely be sent, and why those expecting an instant windfall are setting themselves up for frustration. The schedule is more important than the soundbite, and knowing it gives you control. Let's address the part everyone is waiting for: the actual funds. This is where hopes often detach from reality, leading to confusion and misinformation. So listen carefully. Confirmation of the executive order does not mean payments begin the next day. Government funds don't move that fast. They flow through established systems, on set timetables, through verification layers and compliance gates. Understanding that sequence puts you ahead of the crowd. First, delivery methodology. This isn't a brand new payment method. The structure uses existing federal disbursement channels, the same infrastructure for Social Security, tax refunds, veterans benefits, and other Treasury-managed transfers. That means direct deposit to accounts already on file, government-issued benefit cards, and, for a few, paper checks mailed to addresses of record. Translation: if the government sends you money already, they know where to send this. If they don't, things take longer due to added verification steps. Here's a truth most headlines omit: there is no single payday. There never is with federal distributions of this size. Payments move in waves. Why? Because eligibility is confirmed in batches. Agencies validate groups, Treasury schedules distribution windows, and funds are released in sequences to manage system capacity. This is why some hear of others receiving payments and assume they were skipped, when in reality their batch simply hasn't been processed yet. It's coming, just not on their personal timeline. This order authorizes a staggered rollout by design. It prevents system crashes, lowers error rates, and allows for adjustments if issues arise. They learned from past stimulus chaos that paying everyone at once is a recipe for disaster, so they're avoiding that mistake. Now, on timing. The most plausible internal timeline points to late December extending into January. This doesn't mean everyone is paid in January. It means that's when the first structured distributions become feasible after eligibility layering, account checks, and compliance reviews are complete. If you're expecting a random midnight deposit or a surprise text tomorrow, you're priming yourself for letdown. That's not the procedure. It never is. Regarding the $2,000 figure, this is the most misconstrued aspect. The 2,000 number represents the maximum authorized amount for certain qualifying profiles under the framework. It does not mean every recipient gets $2,000. Some will receive less based on their specific situation. Some may get partial amounts spread over multiple payments, and some may see sums adjusted due to benefit interactions to prevent overpayment. This isn't a bait and switch. It's standard for maintaining federal payment integrity. Another key point. These payments are not automatically taxed like wages, but they aren't invisible to the system either. Their treatment will depend on classification, income level, and reporting rules, which is why agencies are moving cautiously. They want to avoid creating a huge tax confusion problem for recipients during next year's filing season. The last thing anyone needs is an unexpected tax bill due to unclear rules. Let me squash another rampant rumor. This is not a replacement for future stimulus. It is not canceling cost of living adjustments. And it does not mean Social Security payments are being delayed, reduced, or rerouted. In fact, payment systems are being instructed to avoid clashing with existing benefit schedules. This is another reason for a staggered rollout, to prevent overlapping critical deposit dates people rely on for essential bills. Here's where external pressure meets internal process. January isn't just another month, it's a reset point. New fiscal cycles begin, political visibility rises. That's strategic context for the timing of this move. But pressure doesn't translate to instant speed. It translates to careful sequencing. The people who benefit most are those who understand that patience is part of the protocol, not a sign of being forgotten. Let's talk about what won't occur. You will not get a text asking you to verify your bank details. You will not get a call requesting your Social Security number. You will not be asked to pay a processing fee to release your money. Anyone suggesting otherwise is running a scam predicated on your panic. Authentic federal payments come through verified, official channels, not through high-pressure tactics. The government doesn't work like that, and you shouldn't engage with anyone who does. Here's another under-discussed point. Some who qualify will see no immediate activity. Why? Because their payment pathways are undergoing verification or merging. This doesn't mean denial, it means a holdup. Such delays are standard in structured rollouts, especially when multiple agencies need to coordinate. It's aggravating, but it's normal. Let me ask you directly. Would you prefer rushed money that might create accounting headaches later, or verified money that arrives cleanly and doesn't cause future problems? Federal systems always opt for the second choice. That's why this feels slower than many want, but it's also why the payment is solid when it lands. Quality supersedes speed. This brings us to the most vital segment. What should you be doing right now? Because there are intelligent steps and there are panic-driven mistakes. The difference defines whether you stay secure and informed or become vulnerable. Let's bring this to a close because this is where understanding replaces worry and where prudent action replaces reactive emotion. The absolute worst move right now is to panic. The second worst is to dismiss this entirely, assuming it doesn't involve you. The smartest path is right between them. Here's your guide. First, internalize this. There is no need to rush to apply. There's no hidden website, no ticking clock counting down the hours. This framework operates through systems that already contain your data. Your current job is awareness, not frantic activity. The most critical thing to watch for is official correspondence. This could be a letter, a notice connected to an existing benefit account, or an update within a federal portal you already use, like Social Security or the IRS. If you don't get a notice immediately, it doesn't mean you're out. Many won't hear anything until after their eligibility group is finalized and processed. Patience is a prerequisite. Next, take one straightforward step for protection. Ensure your existing information is current. If you get federal benefits, confirm your mailing address and direct deposit info are up to date. If you filed taxes, that data is already in the system. You don't need to create new profiles, just ensure nothing is outdated. Log into your Social Security account if you have one. Check your IRS records. Confirm your bank details. That's it. Simple maintenance, not an emergency scramble. Now, a blunt warning about fraud. Anyone claiming this money has an expiration date is lying. Anyone asking for an upfront fee is lying. Anyone demanding immediate verification through unofficial links or numbers is lying. Real federal initiatives do not use pressure tactics. They proceed quietly, methodically, and systematically. If someone is trying to rush you, they are attempting to scam you. Full stop. Zoom out for a second. This executive action isn't just about one payment round. It's a test of a new model, support tied to system participation, verified data, and precise impact. If this model proves effective, it doesn't vanish after one wave. It adapts. It grows. It could become a lasting part of the policy environment. That's why officials are monitoring closely, and it's why you should too. This could be the start of something more sustained. For countless people, this moment feels like a constant struggle. Higher prices, thinner margins, shaky stability. A policy move like this aims to provide steadiness without spectacle, to assist without media frenzy, and to reach those often missed by conventional programs. If you felt invisible before, stay watchful. If you've been told no in the past, don't assume that answer is permanent. Systems evolve, rules adapt. This directive shows that flexibility is possible when administrative capability aligns with policy intent. The key is to stay informed, not emotionally charged. Reactions fade, knowledge endures, and grasping this now fortifies your position for whatever comes next. Whether this is a one-time event or the groundwork for ongoing support, being informed safeguards you either way. So here's my final point for you. Don't let uncertainty rob you of peace. Don't let fraudsters steal your information. And don't let a quiet opportunity pass you by because you were listening for a shout. The most significant developments often happen without a sound. Stay aware, stay calm, and stay connected to trustworthy sources that provide facts without sensationalism or manipulation. If you value clear, direct updates without the hype, make sure you're subscribed. And to support the channel and help others find this reliable information, please hit the like button right now for my channel. When real information is critical, you deserve to get it first. I'll be here to guide you through every phase, every update, and every new development as this story evolves. You're not alone in navigating this, and you don't have to decipher it by yourself. I'll be right here with you.